So, welcome back, y'all. I had a really good client experience today that I wanted to share with you guys because it's a really quick but nice example of how, when you get to a certain point financially in your life, you can start to make your money work in a way where you can preserve it and even help it grow just by, having a reasonable lump sum of money, but shifting it in the right products to cover unexpected expenses or, just anything that you may be normally paying for that may normally, expense that may normally come through and erode your savings or, your cash flow. I had a client today. He wasn't intending on working with me. He was coming into the transactional side of the institution I work for to do a basic transaction. He had sold a property that he owned. It was a six-figure lump sum. Maybe it was like $500,000. And he inquired, I guess he saw some advertisement and inquired about our CD rates. So he is an existing banking customer. He already has a checking account, savings account relationship, meaning that based on the CD rate, he'd be able to qualify for that special with the relationship rate. For those of you who may not understand or know what that means, basically for commonly for banks, checking accounts are the center of the banking relationship. So even if you brought over $500,000 or $1 million to a bank, if you didn't have a checking account but tried to put it in a savings or went directly to get a CD, you would likely get a less attractive rate, even with that kind of money, than if you had did that same process but also opened a checking account. It's an interesting reality, but for banks, it's checking accounts. For credit unions, it's often savings accounts. It's those center accounts that you have to have in order to get relationship rates or qualify for the best rates on their different deposit products. So he already had an existing relationship and met that metric. He had a lump sum of money. So this was going to allow him to do what's called a jumbo CD, which is anything typically over $100,000. And he would have been able to get 4% on that CD. So he had $800,000 he was willing to use. And he asked me to do the math. He's like, hey, I'm not a math whiz. Can you let me know what that 4% over either a 3, 4, or 5 month term would be on my $800,000? I crunched the numbers for him, did the math. It came out to be somewhere between $10,000 and $12,000, depending on which term he did. And he said, okay, that actually sounds good. Let's do that. So we go through the flow. I'm setting up the CD for him. And we're having conversation. We're talking a little bit about him living in the area, the property he sold. And he's talking about another property he owns. And so he's like, I have this really enormous or abnormally large property tax bill. And this CD is going to pay, the earnings from this CD is actually going to be perfect to pay it off. And it was just it was simple, but it was a really nice light bulb moment because it's like, he basically protected the principal of his money on an unexpected expense because he's used to the property tax bill, but it jumped up significantly, right? So apparently it must have been somewhere in the upper 4 to 5 figures. I didn't get the exact numbers from him on the particular bill, but when I crunched the numbers for him, he had made it clear, okay, this is perfect. I can actually pay this off while not having to use my money to do so. So he basically took his money, which from my understanding was his total retirement savings or a very large chunk of it, $800,000, put it into a CD for about a 5-month term, I believe, where he's going to get around $12,000 by the time that term ends, sometime this summer. And it's going to be enough to pay off his property tax bill and possibly even still leave a little bit of extra earnings and have his principal payment, his principal lump sum perfectly intact. So this is the kind of creativity that keeps the well off. This is the kind of strategy and tactics that keep the rich. Instead of having $800,000 and saying, oh, I have a nice lump sum of money, I got a 4 or 5 figure bill that I wasn't expecting, I'm just going to pay it off out of that money. He did his due diligence, inquired, asked a professional and said, hey, can you help me do the math on this? And in his mind, knowing that he's looking to try to cover this expense. And it's like the perfect strategy to protect the majority of his principal. Mind you, CDs are deposit products. They do have FDI insurance, but it's up to $250,000. He did $800,000. So he has a little bit of risk, but I mean, the reality of the bank collapsing that I work for is very slim. So his money's safe, his principal's safe, it's growing interest, and he's able to use that interest to catch his expenses without touching his goose egg. Light bulb moment, brilliant, simple, but brilliant. This is the kind of way you guys need to be thinking. This is how you need to be functioning. If you have a lump sum of money and you're not invested, then you need to be considering strategies like this to cover some of your smaller expenses, or even to just fund some of your lifestyle assets until you figure out a longer term strategy for your money. This is JP from Blueprint for Prosperity checking out. Thank y'all for tuning in. I enjoyed bringing you the content and the experience, my professional day-to-day experience. I feel like it's an excellent educational opportunity for those of you who are out here looking to level up your finances, because many of my clients are just like you, and they're bringing scenarios and bringing questions and allowing me to bring my creativity and my professionalism and knowledge into the equation to help solve a lot of the challenges and help them reach more of their goals. And I'm trying to help you do the same thing. Thank y'all for tuning in. Stay focused. Stay in motion. I'll see y'all soon.